I need you to take a close look at what just happened in the silver market because this is not your typical price movement. This wasn't a slow, steady climb or a minor correction. We are looking at an aggressive market move that took place after the regular trading session closed, and it has caught almost everyone off guard. As the electronic Globex session opened on Sunday evening, silver prices didn't just move higher, they exploded to $106,055. For those who aren't glued to the screens, Globex is the CME Group's electronic platform that runs nearly 24 hours a day. It is where the big institutional players, international buyers, and high-frequency algorithms trade, while the physical pits in New York and Chicago are closed. When you see a price jump this violent during off hours, it tells you something critical. It means that demand showed up with massive urgency when there wasn't much liquidity to absorb it. Someone, somewhere, needed to get their hands on silver exposure immediately and was willing to pay a massive premium to do it. In a market where most people are just trading paper contracts, this kind of move is a signal that the gap between the paper price and physical reality is finally starting to crack. The paper versus physical disconnect. To understand why this 106.55 price point matters, you have to look at what has been happening under the surface for the last 18 months. We have been watching the COMEX registered silver inventories very closely. Registered silver is the metal that is actually sitting in vaults, ready to be delivered to whoever holds a futures contract. That number has been sitting at historic lows for a long time. Meanwhile, the number of people holding contracts, known as open interest, is still very high. It's a game of musical chairs where there are 20 people for every one chair available. On top of that, if you go to a local coin shop or look at online dealers, you'll see that physical silver coins and bars are selling for way more than the spot price you see on the news. In the US, we are seeing premiums of $4 to $6 over spot for basic silver products. The mints are struggling to keep up, and dealers are having a hard time finding inventory. So, when silver rips higher on a Sunday night, when most retail investors are asleep, it's a sign that the paper system is under extreme stress. The myth of abundance. For a long time, the mainstream narrative has been that silver is just an industrial commodity with plenty of supply. We've been told there is no monetary reason for it to be expensive. But if that were true, why does the price behave like this? Why does it gap up so violently in off hours when trading should be quiet? The truth is that the narrative of abundance is a myth. The stockpiles that used to act as a buffer for the market have been drained by decades of industrial use. Every year we use more silver than we mine. This isn't just a prediction for the future, it is our current reality in 2026. Think about the world around us. Solar panel installations have doubled in the last few years. Electric vehicle production is ramping up, and 5G infrastructure is being built out across the country. Every one of those technologies is silver intensive. Then you have the defense industry. Our military is consuming silver at record rates for guidance systems and high-tech weaponry. The deficit between what we pull out of the ground and what we use is real, and the buffer is gone. The technical coil and the breakout. Before this overnight spike, silver had been sitting in a tight range between $100 and $104. In the trading world, we call this coiling. It's like a spring being compressed. Most traders were looking for a move above $104 with some volume to confirm a breakout. What we got instead was a supply panic. Going from $104 to $106.55 in a single session isn't just a breakout, it's a short squeeze. It tells us that at 103 eyes or $104, there simply weren't enough sellers. Buyers were forced to chase the price higher just to find someone willing to part with their contracts. When these moves happen outside of regular hours, It often means the real action is just beginning because the paper market structure is showing its first major fractures. Geopolitics and the strategic reserve. We also have to look at the global stage because nothing happens in a vacuum. For months, China has been systematically restricting the export of critical materials. We've seen them clamp down on things like antimony, gallium, and germanium. There has been a lot of quiet talk about silver being next on that list. China knows that silver is a strategic industrial material. It is essential for modern tech and defense. If China, which is one of the world's largest consumers and producers of silver, decides to prioritize its own domestic stockpiles, the rest of the world will face an immediate supply crisis. Meanwhile, here in the United States, we are seeing a bipartisan push to bring manufacturing back to American soil. Between the CHIPS Act and the Inflation Reduction Act, billions of dollars are being poured into domestic semiconductor and solar panel production. Every single one of those factories will need a steady supply of silver to function. We are seeing a collision between surging industrial demand and a world that is becoming more fragmented by trade wars and tariffs. The bearish case. What could go wrong? I want to be clear that I am not here to just give you the bull case. You need the full picture to manage your risk. Volatility is a two-way street. A move this violent on thin liquidity can reverse just as fast if the buying pressure was just a temporary spike. There are three major risks we have to keep an eye on. 1. The flash spike. We have seen prints on the charts before that didn't hold. If the regular trading session opens and the big banks start selling, we could see a pullback to $100 or even lower. 2. Paper intervention. We know that bullion banks hold large, short positions in silver. If their positions are threatened, they have tools to try and suppress the price. They can raise margin requirements on futures contracts, which forces people who are long to sell. We saw this in 2011 when silver hit $49 and the rules were changed mid-game. 3. Liquidity crushes. In a true economic panic or a credit crisis, people sell everything that isn't nailed down to cover their losses elsewhere. We saw this in March 2020. Silver fell from $18 to $12 in 2 weeks, not because the fundamentals were bad, but because people needed cash immediately. Despite these risks, the long-term fundamentals haven't changed. The silver, what we saw on the Globex exchange, isn't just a price move. It is a signal that the entire mechanism we use to price silver is starting to fail. For decades, the price of silver has been set by people trading futures contracts in New York and London. Most of these traders never actually want the metal. They just want to profit from the price movement. But what happens when the people who actually need the silver, the industrial users and sovereign nations, start demanding delivery? You get a situation called backwardation. In a normal market, silver for delivery next year should be more expensive than silver for delivery today. That is because you have to pay for storage, insurance, and interest. But right now, we are seeing the opposite. People are willing to pay more for silver right now than for silver in the future. This is a massive red flag. It tells us that the market is in a state of panic over physical availability. If you wait, the metal might not be there at any price. The bullion bank trap. This brings us to the big players in the room, the bullion banks. If you look at the official reports on who is betting on silver, you will see that a handful of large commercial banks hold massive short positions. This means they are betting that the price will go down. Now, these shorts are technically supposed to be hedges against the physical silver they hold, but the sheer size of these positions has always raised questions. We aren't talking about conspiracy theories here. We are talking about documented history. In 2020, JP Morgan paid nearly $1 billion in fines for spoofing the precious metals markets. If these banks are still holding massive short positions while the price is ripping toward $110, they are in a very tight spot. They have two choices. They can buy back their contracts to stop the bleeding, which would act like gasoline on a fire and send the price even higher, or they can double down and try to sell even more paper silver to cap the price. But with physical inventories at all-time lows, the double down strategy is becoming a lot more dangerous than it used to be. 1980 versus 2026. Why this time is different. Whenever silver makes a move like this, people immediately bring up the Hunt brothers in 1979 and 1980. Back regulators. Today, the buying pressure isn't coming from two brothers in Texas. It is coming from sovereign nations like China, industrial giants like Tesla, and millions of individual investors around the world. You can change the rules to stop a couple of billionaires, but you can't change the rules to stop the entire global solar industry from needing silver. You can't margin call a nation that is stockpiling silver for its national defense. The demand today is decentralized and driven by necessity, not just speculation. The 2011 parallel. The other comparison people make is to 2011, when silver almost hit $50 again before crashing back down to $14. That rally was killed by a combination of coordinated margin hikes and a belief that the Great Recession was over and fiat currency was safe again. But look at where we are today compared to 2011. Our national debt is at levels that were unimaginable 15 years ago. Inflation is a persistent problem, and the soft landing everyone keeps hoping for feels more like a fantasy every day. In 2011, the world still had a lot of faith in the US dollar system. In 2026, that faith is wavering. Central banks around the world are currently buying gold at the fastest pace in history. They aren't doing that because they think the system is stable. They are doing it because they are hedging against a currency crisis. The final verdict: what's the move? So, after this massive spike to $106.55, what should you actually do? First, don't let FOMO, the fear of missing out, drive your decisions. If you aren't in the market yet, chasing a 15% move in a single day is a risky move. Silver is famous for fake outs. It wouldn't be surprising to see a pullback to $100 or even $95 as the big banks try to shake out the weak hands. But if you are holding physical metal, this move is a massive validation of your thesis. The paper price is finally trying to catch up to the physical reality. We are in a structural deficit that cannot be fixed by a few trading rules or a media narrative. Here are the 3 things to keep your eye on this week. 1. The New York Open. See if the $106 price holds when the regular session begins. If it does, we are in a new era for silver. 2. Inventory reports. Watch the COMEX registered silver levels. If they continue to drop while the price is rising, the squeeze is accelerating. 3. Physical premiums. If you see the spot price go up, but premiums at your local dealer stay the same or rise, it means the shortage is getting worse. The gap between paper promises and physical reality has never been wider. The setup for silver is asymmetric, meaning the potential for it to go much higher is far greater than the risk of it crashing back to old levels. Stay sharp, do your own research, and remember that in a world of digital illusions, physical assets are the only things that truly belong to you. I'll keep a close watch on the vaults and the headlines and let you know the moment something else breaks. Take care of yourselves out there.